Let's talk about CVS, the place where you go for aspirin and leave with a garden gnome, an existential regret. Lately, their stock price has been dropping faster than my interest in another streaming service. So, is CVS a bargain or a value trap? Is it a hidden gem or a financial black hole? The market's not sure, and neither are we. CVS stock is cheap, but is it for a good reason? Today, we're diving in to find out. We'll look at the numbers, the strategy, and the chaos of American healthcare. Is CVS the comeback kid? Or just circling the drain with a great candy aisle? Let's find out. CVS Health isn't just your emergency Pepto stop anymore. They want to own your whole healthcare experience. Think pharmacy, insurance, clinics, even in-home care. They bought Aetna, Oak Street Health, and Signify Health, aiming for a vertically integrated healthcare empire. The plan: control every step doctor's visit, insurance, prescription, follow-up. It's bold, potentially lucrative, and incredibly complex. But all this empire building has left them with a financial hangover. CVS wants to be indispensable in American healthcare. The system's a mess, and CVS wants to be the solution, or at least a profitable part of it. It's not just about greeting cards anymore. It's about becoming a healthcare giant. CVS is looking a bit sickly. The stock price has tumbled, spooking investors. They're closing hundreds of stores, optimizing their retail footprint, raising questions about the future of the corner drugstore. Staffing is a mess. Overworked pharmacists, pharmacy wasteland, burnout. Not great for customers or accuracy. And then there's regulation. Governments are eyeing the healthcare industry, especially pharmacy benefit managers, or PBMs. New rules could mean lower profits. CVS faces real challenges on all fronts. The pressure is on. Let's talk PBMs, pharmacy benefit managers. CVS Caremark is a giant in this space, and it's the engine of CVS's profits. PBMs negotiate drug prices, create formularies, and process claims. They're middlemen, and they make a lot of money doing it. But this business is under fire. Regulators and politicians want more transparency. If the PBM model gets disrupted, CVS's profits could take a hit. Critics say PBMs add complexity and cost, not savings. Are they helping patients or just themselves? The answer could reshape CVS's future. It's a high-stakes game. Let's look at the upside. America's aging, and older people use more health care. Good news for CVS. They still generate strong cash flow, which helps pay down debt and fund dividends. That dividend looks attractive, with the stock price so low. The valuation is cheap. Maybe a hidden gem, maybe a warning sign. For value investors, it's intriguing, but is it cheap for a reason? The company's financial immune system is strong, but the future's uncertain. If management can turn things around, there's real potential, but it's a big if. Only time will tell. Now, about that elephant, debt. CVS took on massive debt for those big acquisitions. When interest rates were low, it was manageable. Now, with rates up, servicing that debt is expensive. High debt limits flexibility and raises risk. Every dollar to interest is a dollar not spent on growth or shareholders. CVS needs these acquisitions to pay off fast. It's a tough balancing act in a tougher economy. The debt question looms large. Thinking about buying CVS stock? It's cheap, the dividend's tempting. But ask yourself, can CVS actually pull off its grand vision? Can they blend pharmacy, insurance, and clinics into real sustainable growth? Where will future profits come from, especially with PBMs under scrutiny? Can the new acquisitions deliver? Or were the projections just hype? And what's the real plan to pay down all that debt? Is the dividend safe, or is a cut coming? Is this a bargain, or is the market right to be wary? Look past the price. Check the health of the business. Sometimes a sale is just a warning sign. Do your homework.